I think Sonia, you'll have to pick up.
Okay. Well, for the market, it is, as of now, doing pretty well. So up 150 points on the Nifty, Sensex up almost about 500 points. Good time to get in our expert for the day, Vikash Kumar Jain, who's the investment analyst at CLSA, joins us now to talk about the market, all that's been happening so far in different stocks and sectors as well. Vikash, welcome to the show. Thanks a lot for being with us. Do you see this market continue to trend lower, both globally and in a market like India? Yes, India has outperformed, but do you think that this rally can pause further for now?
Hi, thanks for having me. So the way to look about that is, when we look at various metrics, and in fact, we've come out with a note just today itself, we are struggling to find any margin of safety in the market. So just yesterday, as US bond yields went higher, Indian bond yields hardly reacted. What that has done is the differential between US and Indian bond yield has fallen to the lowest level in the last 13 years of about a little over 3 percentage points or so. Now, US bonds are considered to be the safest haven assets in the world, or the largest and the most liquid safe haven assets in the world. Simply put, there are various things which will go into determining this difference, but simply put, what the market seems to be suggesting is that rupee depreciation itself is likely to be 3% or lower on an annual average basis from here on for the next 10 years. We, historically over the last 3 to 5 years or 10 years, the average has been anywhere between 4 to 5% annual depreciation in INR. So just that makes us a little unsure on whether that 3% is something which is likely. Plus, the fact is that our forex reserves have also kind of come down to levels where we are covering only 9 months of import cover. Historically, going below 8 months has not been has been a little bit of a worry for the currency itself. So we're not feeling that we are in such a situation that we can get very comfortable about the currency being depreciating far less than what it has done in the last 5-10 years. Secondly, if we also look at the differential between bond and equity valuations, so that is something which is already at its higher extreme. So historically above 2% or so, whenever one has invested money in equities, they've ended up losing money. So we are already at about 2% difference between 10-year bond yield of India and equity earnings yield of India. So essentially, basically, we have completely eaten out or extended ourselves both on the differential versus the bonds in the US, as well as our own equity valuations versus our own debt valuations. Historically, wherever we are right now in terms of our bond equity valuation differential or absolute PE has not delivered positive returns. So basically, we are at levels which has very limited margin of safety, and history is stacked against us to get significant positive returns. So absolute positive returns and large positive returns from here on over the next 12-15 months or so looks very difficult on the index.
The 5 most dangerous words in finance. Could this time be different, Vikash?
Well, I hope so, and I hope that I'm wrong. But essentially, a lot of things have to be different from that perspective. So what are the things which have to be different? Number one, our currency has to be far more resilient. Number two, suddenly people have to start realizing that perhaps Indian bonds are way more safer than US bonds. And thirdly, suddenly people have to start believing that, the growth that is offered by Indian equities will be far higher than any time in the past that Indian equities have offered, and therefore ignore the bond yields at all. So, I'm not betting on all of that, but those are just a list out. What are the things that need to be very different for, this view to be wrong?
So this is a macro call, or you're kind of modeling that into how earnings will come under pressure because of all of this, and how does this kind of feed in, or these are just macro indicators and you kind of flip negative or positive based on them? I mean, at a time like this, right now, for now.
This is a macro call on the market. We're not going into specific stocks and earnings of that. Now, these assumptions, just to kind of give you a sense, at a point when US yields have gone up by 150 bips in the last 2 months or so, essentially, if you were to turn back and ask me what is needed, we were at about 18,000 very recently. What is needed for the market to go up to 19,000 or so, or 19,500 plus, say by March? I think Indian bond yields have to come down to 7%. Okay. Number two, earnings should not be downgraded from here on. And number three, we should be able to keep trading at the upper band of this differential between equity and bond yield, which we are anyways been flirting with over the last 2 months or so. So essentially, all of those picture perfect things need to play out for us to get 15% return, from here till March. So essentially, it's a tough one, simply put.
Okay, it's a tough one. Let's do one thing. Let's talk about sectors, right? Because there's so much that's happened, for example, in the cement space recently with Adani's investment there. You guys at CLSA upgraded ACC to an outperform just a while back. Tell us about how the dynamics of the industry could change post this large entrant, and what do you do if you're a holder in cement stocks?
So, see, this large entrant, without getting into specific stocks and names, clearly appears to be wanting to take a bigger share of the pie. Now, if that could come through both both organic as well as inorganic means. If it is organic means itself, which is what the large entrant appears to be banking on, then that will mean a much bigger increase in capacity. So from a competitive intensity perspective as well as a demand supply perspective, it will become a more difficult sector than what it was before that. So from that perspective, we do not really have any strong bias in the sector.
Are you, Vikash, I mean, across your team at CLSA, which team exudes the most confidence about future returns right now? Is it the banking team? Is it it's a sector question, basically?
So simply put, see, I think we are still not sure. If we were to look at the US, the real yields in the US, that is, say if you were to look at the 10-year yield minus CPI or the Fed fund rate minus CPI, these are at 50 to 60-year lows. These are the lowest levels we've seen since at least 1960s or so. I was actually recently in the US, and if you go to, you don't really feel like you are in an economy which is in recession. Activity over there and demand over there seems to be pretty robust. So, and the Fed governor recently said that they're actively looking at bringing down, raising unemployment to a level which is more sustainable versus the record low levels that it is right now. I think, and the one thing that I was able to notice is that clearly there is still a significant job openings which were there, which you could figure out just kind of walking on the street. So from that perspective, and the fact that real rates are so negative, makes us actually worry that Fed could actually continue hiking. So we are in a rising yield environment. In India, so far, balance sheet concerns do not really look that big. So from that perspective, if you're in a rising yield environment and balance sheet concerns aren't really there, then banks should continue to be the preferred bet. And that's something that we've liked for a while. We continue to keep that as our favorite sector in the large cap space.
Well, let me answer Prashant's question for you, right? There's, apart from banking, there's also the hydropower sector that you like, if I'm not wrong. Recently, you all initiated a buy on SJVN, on NHPC, and this renewable energy space is coming up in a big way, but there are problems that these companies face as well. Do you think this is, the up-and-coming space for investors to look at?
So, I mean, that report that my colleague recently published, a pretty big 250-page report, where we talked about that hydro is honestly India's answer to its longer-term green goals in terms of getting to net zero. And hydro could actually, he kind of makes an interesting case on hydro should be used as a way to be considered as what batteries can do in terms of power storage. That's something which can be done by hydro. So that is a very interesting piece for our clients to read. And, we believe that over the longer term, when people are looking at green plays or plays to new energy, even hydro stocks appear to be interesting ones.
All right, we'll leave it there. Vikash, thanks very much. Great speaking with you as always. And Vikash, of course, I mean, is not very positive in terms of prospects for the market overall. at this point in time.